Hello, good evening, everyone. Welcome back to the channel. I'm here with you all very quickly today on a video of a brand new fund called TPAY by Roundhill. So let's go over everything we know about this fund so far, because I know maybe a little bit more than you all, probably the ticker and things like that. But let's go over this fund and review and see if it's a possibly viable addition to our portfolio. So first, what we're going to start off with here is a quick summary. So the TPAY is by Roundhill. So it's the Roundhill S&P 500 Target 10 Managed Distribution ETF. Brand new, just launched February 18th. Actively managed, designed to provide exposure to the S&P 500 while delivering a fixed 10% annualized distribution rate through monthly payments. Now, this seems like this will compete almost directly with SPYI and some of the others, like by Neos. So expense ratio is only 0.49%. The primary objective, obviously, is the targeted 10% annualized distributions paid monthly. The investment strategy, it's going to use SPY Flex options, which are flexible exchange call options, as we discussed with Mike about a week ago, to gain exposure to the S&P 500 while managing its capital for distributions. Now, this is supposed to be 100% ROC, so it should be very tax efficient. Currently trading at 50.59. It looks like, oh, look at that. It's already got NAV erosion of 41 cents. So just went public on February 18th. Okay, so the key benefits here, obviously, it's a very tax efficient vehicle. So from a tax efficiency standpoint, all right, so a significant feature of TPAY is going to be its aim for distributions to be treated as return of capital, like we just said. This generally defers taxes by reducing the investor's cost basis rather than being taxed as immediate income. So it's expected to be as high as 100% ROC. We'll have to verify that, but that's what I've seen so far based on initial estimates. The NAV erosion risk, because the 10% distribution is fixed and can be paid regardless of fund performance, there is a risk of principal erosion. Now, this is why I like to use this tool, because it's very good at summating points like this. And now every fund I research, it's starting to add a section for NAV erosion. So there is a risk for principal erosion. If the S&P 500 does not appreciate by at least 10% annually, plus expenses, the fund may be forced to pay out investors' own capital, leading to a decrease in the net asset value or NAV over time. That's what we refer to when we say NAV. Not everybody refers to it properly or uses the proper mnemonic conventions for it, but essentially that's what we mean when we say NAV erosion. So obviously, there's been a problem with a lot of high yield dividend funds. I don't particularly consider 10% to be high yield. Now, the thing is, with the S&P, name a year just off the top of your head that the S&P's performed less than 10%. You could probably think of 2022, 2018, 2008, probably 2011 off the top of your head. But think about this. In the last 20 years, it's probably 5 of the last 20 years or so. So that's really only like a fifth of the time. So the risk of less than 10% return annually in the S&P 500 is getting lower and lower. It's already low to begin with, but I believe it's getting lower and lower. Market context, similar managed distribution funds like the Roundhill S&P 500 Target 20, which is called XPAY ticker, have been noted by analysts as potentially unsustainable in flat or bear markets where high yield targets can aggressively deplete the fund's base. As a new fund with limited assets under management, or AUM, investors should monitor trading volume and bid-ask spreads for potential liquidity issues. Now, this is the biggest thing I see when it comes to trading options on funds like these. This may or may not have an options chain available yet, but I see this with WPay as I'm trying to wheel my way out of it, as opposed to weasel my way out of it. Instead of doing that, I'm trying to wheel my way out of it. See what I did there, huh? Right? Thank you, folks, for tuning in. Please smash that like button. Helps me to bring you more awesome content like this. So I've got about 3 more minutes with you fine folks before I skedaddle. Okay, so with that being said, yeah, the options, the bid and the ask spreads are very wide on relatively illiquid funds until they get a big volume of AUM. That's a big reason why, just as a side note, that's why I stopped trading NVDX, and that's why I trade NVDL, because it's much more established fund, better AUM, better liquidity, even though it costs more. Cheap is not always better. Remember that, folks. Okay, so with that being said, alternative TPAY. I like the acronym because my rapper nickname in high school was T-Pain. So those of you that know my name, it makes sense. So TPAY kind of sounds similar to one of my favorite nicknames. So ensure you're not confusing this ETF with other products that have used the name or similar symbols. TPAYX, it's a TCW Private Asset Income Fund. And then formerly, the last ticker for TPAY was EcoFin Digital Payments Infrastructure Fund. Would you like to compare TPAY's 10% target against other income generating strategies? Yes, let's do it. Let's see what it tells me. You know, honestly, this is better than the Magic 8 Ball that I used to use. Okay, so some competitors, let's just compare strategy here. So TPAY and covered call ETFs like JEPI share the goal of high income, but differ significantly in how they generate and protect that cash flow. So TPAY versus XYLD and JEPI. These are the income source is fixed target distribution from a mix of capital gains and SPY flex options. Covered call, obviously, primary income source option premiums collected by selling or writing call options. Payout stability, variable with these where it's fixed here. So I think there's less risk with the fixed payout. Upside potential is very high with this strategy versus capped for covered call ETFs. Tax treatment aimed at return of capital, which defers immediate taxes, whereas covered call ETFs have it mixed. The market environment, the covered call ETFs obviously excel in sideways or slightly down markets where they capture premiums without being called away. TPAY is designed for investors who want a steady 10% check regardless of market mood. That actually sounds very appealing. So with that being said, I'm going to end it there. I just wanted to do a quick video. So I really appreciate you all tuning in for this one. Please like, comment, and subscribe and join Discord. And we will see you all on the next one. Take care. Bye.